Welcome. In each of our lives, there are times when we need to make a decision, but we don't know what the outcome is really going to be, so we need to weigh the risk reward factors before we make that decision. Sometimes when I was younger, I would play with matches in the backyard. One time, I asked one of the prettiest girls I knew to the senior prom. I got burned on both occasions. One time, a group of friends and I climbed to the top of Nevada Falls in Yosemite. Once there, we were eating our lunches, and some people came by and told us they were on horses, but they told us that they had seen a bear and that it was coming our way. So we climbed on top of a tall boulder. It was about 10 feet up, and we waited. When the bear came by, and discovered a sandwich inside a sweatshirt one of the girls had left on the ground, he grabbed it. Yep. Now, as he was leaving, the girl that owned the sweatshirt that it was in pleaded with us, "Someone do something to rescue my sweatshirt." So I climbed down and followed the bear to a tree a few feet away. So I was on one side and the bear was on the other side. I had heard somewhere that you can scare a bear by banging two large rocks together. I tried this maneuver, but to no avail. The bear just looked at me to size me up and continued to dig through the garment to find that sandwich. Once he had the food, he just turned away and left the area. Well, then I went over and got the sweatshirt, returned it to its owner. Looking back on that episode, I have to admit that the risk reward factor was not worth it. Sure, I got the sweatshirt back for the girl, but it was only by God's grace that the bear didn't see me as a better meal than the sandwich. Sometimes you do get lucky. Hello. If this is your first time to watch one of our videos, I'm Stephen Mansell, the COO here at Kodiak Capital Advisors. And along with everyone else here, I believe that the more you know about the market and how it works, the wiser your decisions will be. Now, our videos have been describing the actions of a conservative, intelligent investor. But there are other intelligent investors out there that have the means and the risk emotions to take a higher amount of risk. This video is to persuade those risk takers to still be intelligent investors. Now, here are two ways that risk takers get sucked into speculating instead of being an intelligent investor. First up, investing in junk bonds. Now, they have a lower credit rating, which means a higher risk of defaulting on the bond, and therefore a higher interest rate. Now, for the loan of your money, a bond is a promise from a company to pay you a specific interest payment, an interest payment on a regular basis, and your full principal at some future date. But the risk is that the company doesn't succeed and they default on the loan. Just as you can't squeeze blood out of a turnip, you can't squeeze money out of a company that is broke. Now, junk bonds have a long-term default rate of about 3.5%. The aggressive, intelligent investor will either ignore junk bonds entirely or make them a minimum percent in his portfolio. But he will also do his homework and not be persuaded by the advertising hype like the WorldCom fiasco in 2001. WorldCom had been borrowing money to run their business for several years, but without growing their business to pay off the debt. So, to pay off the debt, they borrowed more money. In May of 2001, they started the largest bond offering in U.S. history, $11.9 billion worth. They were offering up to 8.3% interest rates, which brought in a lot of big players. The California Public Employee Retirement System was one of them. Now in July, just over a year later, WorldCom filed for bankruptcy. They later defaulted on the loans. The bonds lost up to 80% of their original value. But if you had taken the time, even a casual read of the bond's prospectus would have shown the intelligent investor that WorldCom would not be able to keep up with the interest rates, given their current earnings. Nothing changed. I would say, never jump on the bandwagon without checking out the power and stamina of the horse pulling that wagon. Okay, second up is the art of day trading. Now, this is where the aggressive investor buys and sells stocks within a few short hours to take advantage of the small changes in a stock's price during the day. But the percentage of buying low and selling high is low. Add to that, one, the broker's cost of each buy and sell transaction, and number two, the capital gains tax amount when you do succeed means you have to sell it around 10% higher than you bought the stock just to break even. Just to break even on that one trade. If you sell for less than that, or even for less than you bought the stock, you have to make up for it on another trade. Benjamin Graham calls day trading one of the best weapons to commit financial suicide. It should never be a part of the intelligent investor's thinking. The point I'm making is that the aggressive investor should follow the same rules that the conservative investor uses. Just because you're not afraid of a bear market doesn't mean you should follow the speculative advice of others and bang two rocks together. That would be silly. Investigate the nature of the bear and only engage it if the risk is worth it. This video has presented some general information regarding the financial world. To talk with me or someone on our staff about your specific situation, your specific portfolio, click on the call button below and we will contact you as soon as possible. There is nothing like a conversation to clear up uncertainties. If you found this video helpful and you would like to see other informative videos, or you think others would benefit from them, then click the like and the subscribe buttons below. If you have a question or an idea for a future video, write us a note in the comments. In future videos, we will be going through some of the ways people have used to gamble in the market, and we will compare it to how the intelligent investor would decide to risk his money. I'm giving you examples to show how this financial concept of portfolio management works. But I want you to remember that every individual will have individual results in these situations. Do not think the specific outcome of these examples will be your outcome, and therefore make financial decisions based on it. But instead, we want you to recognize the general rule we are illustrating about portfolio management. Remember, choose well.